Hey, welcome back to Chapter 5, the Bins and Gap Method of Retirement Planning. And we're going to talk about what to do with your money today. So it's, to me, a little more fun than some of the basic fundamentals that we've talked about. But let's put it in context a little bit for today. So glad you're back. I'm Rick DiBiasio, again, founder of Latitudes Financial Strategies. And the information we're talking about today is directly from my book, The Retirement Dilemma, which came out a few years ago and has done pretty well talking about how to structure retirement plans or your retirement plan investing, I should say, once you get to the retirement period. Because here's the retirement dilemma. Interest rates are close to zero, and the stock market is pretty much at record highs. What are you supposed to do with that? That's really hard to decide how to invest. So we've designed a method here at Latitudes that has successfully helped us to help people retire and stay retired. So let's talk about that a little bit. First thing we had you do was have a budget, right? We have a process here for retirement planning, and I need a projected retirement budget, your PRB. And that's a good way for us to get a sense of what it's going to cost you monthly to be retired. And we're going to work with that. Then the next thing we had you do was get organized. And I draw a mind map. Now you can do whatever you want in terms of how to get organized, but part of our process is to just get a handle on the big picture and sort of look at it. And I like the visual idea of having it all on a piece of paper, actual paper, where I can look at my mind map and then make decisions about allocations and kind of see how one decision might affect something in another area that we've put on there. So it's just a sort of methodical way that we have of looking at retirement plans. Now let's give you an example. Let's say that we have a client who's come in, and we'll call them Joe and Janice. They're 67 years old, and their projected retirement budget is $5,000, and their Social Security is $2,800. So as you can see in the green button there, the $1,200 monthly gap turns into a $14,400 annual gap. Now, if you remember, or if you saw our first or second lesson in this series, we talked about what a gap is, and that's the difference between your guaranteed income and your budget. And that money has to come from somewhere, and in the case of Joe and Janice, that's going to come from the retirement rollover accounts. Now, the next thing we do in our way of looking at retirement planning is we decide if our clients are funded or underfunded. And so in the case of Joe and Janice, they have a $14,400 annual gap. In other words, we know, not counting for inflation or any unexpected expenses, that their gap over 33 years is, in today's dollars, going to be $475,200. So then it's easy. Do they have that much money in their retirement account? Now, why 33 years? Because they're 67, and I take these things out to age 100. And I feel like that's the safest way to look at retirement planning. You might decide that your life expectancy is in your family is only 90 or 85 or something like that. That's okay if you want to do that, but it's not really good retirement planning if you live past that age and run out of money. That's sort of the opposite of retirement planning as far as I'm concerned. So then we take that retirement plan balance, and in the case of this example, Joe and Janice, they have combined in their retirement accounts about $800,000. And that's not an uncommon number for me to see for people retiring from some of the major corporations here in Orlando. And so they are funded. In other words, if they didn't make a dime on their investments and they never spent, in this example, if they never spent more than that annual gap of $14,400, then it's pretty much mathematically impossible for them to run out of money. But we take it a step further in every case, and at this rate, they're burning money, if you will, by spending $14,400 out of $475,000. At least the first year, they're taking money out at the rate of 1.8%. So then, again, simple math. This is not an investment promise. I don't know you. I can't, give you investment promises how your investments will return. But just in terms of, in this example, as long as these people make more than 1.8% annual return on their money, they should stay ahead and keep their balance at least where they started. Now that's a goal. We can't always do it. Depends on the year and the environment and the investment mix, but that's a real helpful number to know. And so that if I have a pretty good idea that you only need to make 1.8% on your money to return principal, then I can maybe invest a little differently than I would for somebody who we figure out is spending money at the rate of 7.5% of their principal. It's going to make a difference. And whether we even think retirement works in that particular year, or if you should wait a little longer and build up a little more assets. So that's the start. And I should say, if you're funded or underfunded, one more thing, and that is that you can always adjust your spending lower, or maybe you can't, but if you can adjust your spending lower, your projected retirement budget, or you can maybe wait another year or two when the numbers kind of work more in your favor, so to retire. If you have those two choices, that's really the only way you can do this. I don't think it's a good idea to say, well, I've got 20 years of money, that's good enough for me, because that leads to problems down the road when you're quite a bit older, and it's awfully hard to go back to work at that point, right? So, okay, that's how we look at the basis of retirement. Now, what do we do with your money? Well, we've come up with this idea that's called the bins and gaps method of retirement planning. And it's in my book, The Retirement Dilemma. And it's a way that we can help you develop a potential income for life. Now, we talked about the gaps. That's the gap in your income that we have to cover. And we think of the bins as like these bins over here, where we have everything is in compartments and in different sections. So if you had a workshop in your garage, and in this case here, you can see the guy has a place for gloves and for tape and for clamps and things like that. We want to think of our money going into similar type of bins. It isn't that we open up a separate account for each bin, but it's just a way for us to sort of categorize it. And we do it by going into 5-year increments, okay? So we think of years 1 through 5 as the first bin, if you will. Then the second bin is years 6 through 10, and so on. Bin 3 is years 11 through 15, and finally we go out to 20 years in this. And this is sort of a rolling thing, so we're always adding another year on the end every year. So this should take care of it. Now, with this approach, we help to develop an income that potentially should last you for life. And we also, our goal is then to remove market fluctuations or bad markets from your cash flow. And let me show you how we do this. We take the first bin, okay? And that's years 1 through 5. And we use traditionally very safe investments, things that are, maybe traditionally considered guaranteed by a bank, or might have FDIC insurance. Or we may look at other things that are very safe and don't have a market fluctuation to drive us crazy and are very liquid. So in this case, for Joe and Janice in this example, we'll have 5 years and of their times their gap of $14,400, and that's $72,000. So we will segregate in their account $72,000 that stays in traditionally very, very conservative investments that don't fluctuate. Now we know that no matter what happens to the markets, for the next 5 years, their gap is filled. They've got themselves covered. Now don't forget, this family has $800,000, so to put $72,000 aside is not necessarily something that's going to strap them. But what it's going to do is allow us to have money set aside in their retirement accounts to cover their cash flow for 5 years. Now the second bin, of course, is going to be for years 6 to 10. And it's the same idea. We're going to take that same amount of money, another 5 years worth of cash flow, and we're going to invest that in traditionally conservative investments. And they could be a number of things that may have some market fluctuation, but it just depends on that particular economy and that particular market when we're going. But we're looking at items that we're not planning to touch for 6 to 10 years that have traditionally done well over 6 to 10 year periods. Now, again, we're staying relatively conservative now. So what we've done is we have taken basically the first 10 years of retirement income needed to fill your gaps, to pay your expenses, and we've segregated it out so that even if we have market corrections or crashes or horrible markets, we've got 10 years worth of cash flow set aside. And that's huge. And let me tell you why I do that. When I started in this industry, interest rates were pretty high. And you could get 7-8% guaranteed money. And so we could take, $100,000 and just live off that interest, $8,000 a year just on interest, and theoretically never touch principal. Well, it didn't work out that way, did it? Interest rates have come way down, and now we've had to come out with a way to protect our cash flow. And so we designed this bins and gaps method. And it's a way to make sure that our cash flow stays uninterrupted, and the money that we want to set aside for the longer term part of retirement is segregated from the money we need for cash flow. Now we do this in, as I said, 5-year increments. So bin 1 through 5, bin 1 is years 1 through 5 is cash flow. Bin 2 is conservative. Years 11 through 15 are more growth and income type of investments. And bin 4 is where we would put growth investments. Now, depending on the client, and if you're the client, you're tolerant for risk, your time horizons, your other goals that we put on that mind map that we created, right? That we could put more money, say, in bin 3 than we do in bin 4, or we could do the opposite, put more in bin 4 than bin 3. And we can even add a bin 5, and go out 25 years. But our point is we're segregating short-term money from long-term money. And in this type of interest rate environment, and we're probably in a relatively low interest rate environment for a long time, but at some point, maybe we'll get back to a point where we can earn really high guaranteed rates again. But in the meantime, we have a method of doing this where we know that cash flow is protected, and all we have to do in this case is make roughly 1.8% on our money every year to make up for the money that's coming out. Hopefully we're going to do a lot better than that, but again, there's no guarantees of that. And I can't tell you specific investments on this type of format because I don't know you. And the first rule of becoming a financial planner or an investment guy, rule number 1 that we learn is know your client. So for me to sit on a video like this and say, hey, you ought to buy this stock or this bond or something is folly. So we're not going to do that. But I want to give you the basics for how to set that up. Then it becomes a question of what do you call conservative and what do you call growth and income and things like that. And that's a lot of the conversations I have with clients, is to make sure we're on that same page. So the reason I use the bins and gaps method, and the reason I frankly invented it, was that we want to provide a potential lifetime income. We want to remove 5 years of cash flow from market fluctuations, and we want to provide the proper long-term approach to investing. We're not trying to speculate here. We're not trying to day trade our way to wealth. We're trying to find a way to invest our longer term dollars in a way that will see meaningful growth that will help us to stay ahead of inflation and taxes. That's basically all we can hope for in long-term investing. Now, we are, in my firm, we're what we call tactical investors, and that is that we try to make adjustments and changes based not only on changes in your life, but based on the economy and market conditions too. So we may look at a conservative portfolio as one thing, and 5 years from now, we may look at other things as conservative investments. It just depends on the environment we're working in. But for sure, we always want to have 5 years at least cash flow sitting in what we would call in my business cash or cash equivalents to protect us there. So that's how we do long-term investment planning for retirement. It's something that will give you a structure as you look forward, and I think that should help you out a little bit. And if I can be of service to you, reach out through the website and set up an appointment. We'll be happy to talk to you. I hope this helped. Thanks.